What if I told you America's seventh largest company didn't actually make money? Employees trusted it, banks funded it, Wall Street worshipped it, until $63 billion vanished overnight. December 2001, thousands of employees lost their jobs, retirement accounts disappeared. Investors were shocked. How did no one see this coming? Enron started as a boring natural gas pipeline company in Houston, Texas. Move gas, charge a fee, repeat. Nobody outside Texas cared. Then came Ken Lay. He had one dangerous idea: deregulation. Free energy markets meant unlimited profit potential. Ken Lay hired Jeff Skilling, a fast-talking McKinsey consultant. He believed the company could be more than pipelines. It could be a technology company. "We don't sell energy," Skilling said. "We sell the future of energy." Wall Street applauded. Then came Enron Online. One click, millions moved. Suddenly, Enron wasn't just Texas. It was Silicon Valley in a cowboy hat. Fortune magazine called Enron America's most innovative company, 6 years in a row. Reporters swooned. Everyone wanted a piece of the future. Inside Enron, the culture was ruthless. Employees were ranked every year. The bottom 15% were fired without mercy. Enron didn't just change energy, it changed accounting. Using mark-to-market accounting, they booked 10 years of profit the day a contract was signed, even if the money didn't exist. On paper, Enron looked like a cash machine. In reality, it was fragile. Deals hadn't started, predictions were fantasy, but the stock kept rising. CFO Andrew Fastow created special purpose entities, LJM1, LJM2, Raptors, to hide failing assets. Enron sold its worst assets to these entities, pretending to reduce risk. In reality, it was the same company moving money around. August 1st, 2001, Jeff Skilling resigns. The CEO of America's hottest company walks away. The SEC starts probing Enron's off-balance sheet entities. Smoke was detected, but no bodies yet. October 1st, 2001, Enron admits $586 million in fake profits. Investors panic. Stocks fall from $90 to under $1 in months. December 2nd, 2001, Enron files for bankruptcy. $63 billion gone. Lives destroyed. Futures ruined. Arthur Anderson, Enron's auditor, wasn't watching the books. They were helping hide the fraud. Executives walked away rich. Employees lost everything. The smartest guys in the room, gone. Fastow's creations weren't real companies. They were shells to hide Enron's worst assets and failing deals. Enron funded both sides of these deals, pretending to reduce risk while actually taking it all on. The more the deals looked profitable, the more executives cashed out their stock. Employees were told to trust the stock. Their retirement plans were tied up entirely in Enron shares. Analysts raved. Investors bought. The illusion held. Perfectly. Every quarter, numbers grew. Revenue soared. Profits skyrocketed. But it was all smoke and mirrors. Inside, executives celebrated. Bonuses, villas, private jets, the party never ended. Below deck, employees fought for survival. The culture rewarded ruthlessness and punished hesitation. On the surface, everything looked unstoppable. Enron was invincible, or so it seemed. But behind the glitter, the foundations were cracking, and no one saw it coming. Sharon Watkins, VP at Enron, noticed the irregularities. She warned Ken Lay, "We will implode in a wave of accounting scandals." Lay treated it as a PR problem, not a crime, not a warning, just messaging. The outside world had no clue. Investors trusted the company. Analysts trusted the hype. Executives answered questions with buzzwords: market maker, brain trust, tech innovator. But the real question remained: what does Enron actually do? Skilling pushed forward. Growth, innovation, deals, profits. The illusion continued. 1997 to 2000, Stock rose from $7 to $90, a 1,200% gain in 3 years. Investors thought they were geniuses. Fortune called it miraculous. The media loved the story. No one looked deeper. Inside, bonuses were celebrated. Recognition was everything. Ethics were optional. But under the surface, Enron's house of cards was ready to collapse. August 2001. Skilling resigns. No explanation. The CEO of America's hottest company walks away. The SEC starts probing Enron's off-balance sheet entities. Smoke detected, but no bodies yet. Rumors spread. Whistleblowers worried. Some tried to sound the alarm internally. Ken Lay dismissed concerns. The priority was the image, not the truth. October 2001. Enron admits $586 million in fake profits. Investors panic. Stocks fall from $90 to under $1 in months. Chaos erupts on Wall Street. Phones ring non-stop. Employees stare at tickers in disbelief. Thousands of ordinary employees suddenly realize their 401k savings are gone. Meanwhile, executives had already cashed out millions, untouched by the collapse. America watches as the empire collapses. The illusion of perfection ends in disaster. The numbers were fake, the empire hollow, the smartest guys in the room, gone. Arthur Anderson, Enron's auditor, wasn't watching the books, they were helping hide the fraud. The firm is convicted of obstruction of justice, its license revoked, 85,000 jobs vanish overnight. Skilling sentenced to 24 years, Fastow gets 6, Ken Lay dies before facing justice. Thousands of employees lose their savings, their futures. Belief in Enron cost them everything. Banks like Merrill Lynch, J.P. Morgan, Citigroup profited from the deals. No criminal charges, only fines. The story isn't just about Enron, it's about illusion, about what happens when the world wants to believe so badly that it stops questioning. For 16 years, Enron sold the future and the world bought in, until the lights came on. The numbers were fake, the empire hollow, the smartest guys in the room, gone. A lie can travel halfway around the world while the truth is still putting on its shoes. Remember this story. Question everything and never let belief replace reality.